When I'm working with buyers, it's a question I get fairly often, and that is, if I'm qualified for more money than the house costs, can I use the extra money to do improvements to the house? Hello, I'm Robert Chambers with the Chambers Group at Engel Volkers Colorado Springs. I'll answer that question and tell you some ways to get extra money for home improvement projects today on Realty Talk. On the surface, if you're qualified for more, it seems like a reasonable assumption, but the answer is actually no. Unfortunately, you can't get a loan for more than the purchase price, at least not on a traditional, conventional FHA or VA loan. However, it's not an absolute no, and I'll talk about one product you can use before wrapping up today. I understand the position of wanting to buy a house that may need some improvements and wanting to take advantage of the full amount of the loan to fund a few projects. For instance, let's say you're qualified by your lender for $450,000, and then we found a home to purchase that's $400,000. You really like the home, the layout, and the area of town it's located in, but the house hasn't seen an update in years. One of our first thoughts may be, well, I'm actually qualified for $450,000. Can't I just use the extra $50,000 to install new flooring, update the kitchen, and paint the interior? After all, it would improve the house and add value to it, right? I'm absolutely with you. It sounds reasonable and like a great use of the loan that you're qualified for. But here's the hitch. First, a home mortgage loan is not the same as a personal loan. So what actually qualifies for the loan amount is not only your personal credit, it's really the house and the current condition at the time of the purchase and closing. In addition to that, an appraisal will be completed on behalf of the borrower and the lender. The appraisal is completed to verify whether or not the house meets the use, condition, and comparable value for the neighborhood where the home is being purchased, and that neither the buyer nor the lender is at risk of overpaying. Remember this, and it'll make sense. The mortgage banks are simply investors and they want to make sound investments. So whatever the amount of money being loaned on a house and the house itself is the lender's bank's investment. They won't loan or invest money into a project you intend to do at some point in the future. No, they will only loan money on the appraised value of the home. Look at it this way. Let's say, hypothetically, they did loan someone $450,000 on a $400,000 house. Now let's say the person that they loaned the money to immediately lost their job after closing, or for any number of reasons never made the first payment on the house, and it ended up in a long, drawn-out foreclosure process. The bank would now own a liability that is worth less than what they invested in it. And if they're lucky, they can get the $400,000 market value, but that's not even likely in most cases. And what about the extra $50,000 they loaned above the appraised value? Well, to be blunt, they would eat that loss as a poor investment. This is one reason they won't make this type of an investment in the first place. When we understand both the borrower's and the lender's perspectives, it's easy to see why the borrower wants the extra funds, but why the lender wouldn't gamble on getting all of their money back on that investment. However, if you love the home and the location, and even though it's not ideal now, but still livable, you have a couple of options. Since you couldn't finance the extra $50,000, your monthly payment will be a bit lower, and you can move in and save up for one project at a time, pay cash for it, and know that you own it, having never paid a single interest payment on that improvement. Second option is, you can live in the house for a while, make mortgage payments, and wait until you have some equity built up. You can then reach back out to the lender and request a refinance with a cash out option, and use that money to complete your projects. In addition to being a realtor, I'm also a certified financial coach, so I'm going to wear that hat when telling you this. I would choose the first option because borrowed money always costs more than cash, and being patient will save you money. But if you do decide to take cash out during a refinance for projects, then spend that money only on the projects. If you have money left over, add it to your next mortgage payment above your normal monthly payment and pay that down before the interest begins to accrue. You don't want to end up financing a cheeseburger, a fancy dinner, an Xbox, or a 75-inch TV for the next 30 years, which is what will happen if you spend money from an interest-bearing loan on anything other than your home and only your home. There's actually one more option, but I would take it off the table completely, unless you have the discipline and financial ability to pay it back quickly, like within months of completion of your project. I'm talking from experience, so I have a strong opinion. That option is known as a HELOC, and you've probably heard it referred to as a home equity line of credit. For me, this is the last resort measure, and I would never do it again. And let me tell you why. My wife and I really wanted to improve our backyard by adding a deck and outdoor kitchen before the summer started. And we thought, hey, don't most people get a home equity line of credit for those types of projects? We must have thought it was a great idea because at the time we took a $37,000 loan out of a $50,000 HELOC and completed the project. Like most people, we paid and paid and paid on that for a couple of years, and the balance never decreased because you pay nothing but interest for a given period of time before decreasing the principal amount. Paying and paying and never gaining any traction feels like the trap that it is. Believe me, I never want to be like most people ever again. Fortunately, we later refinanced to a great lower rate and reabsorbed the HELOC amount into our mortgage. I think we got very lucky that the low rate came around, and because my wife and I are in the business, we were aware enough to take advantage of the refinance. When you think of a HELOC, think of it as a credit card against the equity of your house. Any purchases made are going to have interest attached to everything you buy, and it feels like you'll be paying for an eternity. If you get a HELOC, please use it only for the intended purpose and pay it back as if your life depended on it, because financially it does. I don't want that kind of burden on you. Lastly, there is a loan product out there that will let you make improvements in the course of purchasing a home, but it's a special product with special circumstances and qualifications. You can buy a house and have all the improvements completed under the same loan. But again, there are specific steps to take, and I can't possibly unpack all of the details here and now, so if that's something you'd be interested in learning about, leave me a comment below, or you can text or email me. The Chambers Group can personally help you with your real estate needs. We'd be honored to be of service.